Have you ever worried about investing at the wrong time, right before the market dips? What if there was a strategy that took away the stress of timing the market and let you build wealth step by step, no matter the conditions? That's exactly what dollar cost averaging, or DCA, is designed to do. In today's video, I'll break down how it works, why investors still rely on it in 2025, and the risks you need to know before you start. Welcome back to the channel. If you're new here, I cover trading and investing strategies that help beginners and experienced investors alike make smarter choices. Today, we'll dive into dollar cost averaging, often called DCA. We'll cover the basics of how it works, its benefits, its downsides, and some real examples in both stocks and crypto. By the end, you'll have a clear picture of whether this long-term approach fits your own investing style. Dollar cost averaging is an investment strategy where you invest a fixed amount of money into a target asset at regular intervals. It doesn't matter whether the market is going up or down, the amount and timing stay the same. The idea is simple. When prices are high, your fixed amount buys fewer shares, and when prices are low, that same money buys more shares. Over time, this lowers your average cost per share. This method is popular with people who want to avoid the pressure of guessing when to enter the market. Instead of trying to time the highs and lows, you simply keep investing steadily. The benefits of DCA are easy to understand. First, it removes emotions from investing. You don't have to worry about panic buying or selling because the strategy is automatic. Second, it builds consistency, creating the habit of investing regularly, which is often the real key to long-term wealth. Third, it lets you automatically participate in recoveries. If markets fall and later rise, your regular purchases at lower prices improve your overall gains. Finally, it helps smooth out volatility by giving you a lower average cost basis compared to making a single large purchase at the wrong time. Of course, no strategy is perfect, and dollar cost averaging has risks. If the market stays in a long-term downturn, you could end up buying more and more of an asset that keeps losing value. In strong bull markets, you might actually make less than if you had invested a lump sum all at once. DCA can also encourage overconfidence in individual stocks that may never recover, which is why many experts recommend it for diversified funds or index ETFs rather than single risky assets. So while DCA is powerful, it still requires discipline, patience, and smart asset selection. To see DCA in action, let's consider a simple case. Imagine an employee investing $100 every 2 weeks into a retirement plan. Some months the market is higher and they buy fewer shares. Other months prices fall and they buy more. After several months, their average cost per share ends up being lower than if they had made a single lump sum purchase at the beginning. In crypto, many investors apply the same logic. Someone who put $50 into Bitcoin every week over a year would have bought during both dips and rallies. Instead of stressing about whether Bitcoin was at 45 or 60,000, they averaged their entry price over time. This is the same principle behind dividend reinvestment plans in stocks, where dividends are automatically used to buy more shares. In 2025, dollar cost averaging is still one of the most recommended strategies, especially in uncertain markets. Merrill Lynch highlighted it as a core approach this summer, reminding investors that steady contributions often outperform market timing in volatile conditions. Forbes found that DCA outperformed lump sums in down markets 68% of the time, though it lagged when markets trended steadily upward. Morgan Stanley explained that preset contributions, like $200 a month into ETFs, can compound into 7 to 10% annualized returns over decades. Even in crypto spaces, posts on social media show traders proudly documenting daily or weekly DCA progress. Many stress that consistency is the real weapon, proving that staying the course matters more than short-term fluctuations. So what's the verdict on dollar cost averaging? It's a strategy that removes stress, creates discipline, and helps smooth out the roller coaster of market volatility. It shines when markets are choppy, and it's especially well suited for beginners who want to build wealth slowly and steadily. But it's not magic. In strong bull runs, lump sums may perform better, and buying without research can lock you into underperforming assets. The bottom line is this: DCA is not about predicting the future, it's about building consistency. If you combine it with smart asset choices like diversified funds or ETFs, it can be a powerful long-term tool. To recap, dollar cost averaging is a simple but powerful strategy that helps investors reduce timing stress, average their entry price, and stick to long-term wealth building plans. In 2025, it remains one of the most widely used approaches across both stocks and crypto. If you found this explanation useful, make sure to like this video, subscribe to the channel, and hit the bell icon so you don't miss future investing insights. And let me know in the comments, do you use DCA or do you prefer lump sum investing?